Hello and welcome back. In today's lesson, we're going to describe the four basic assumptions underlying GAAP and that are part of the conceptual framework, and we're going to describe the recognition, measurement, and disclosure concepts that guide the accounting practice. Let's go briefly over the conceptual framework. And the conceptual framework of accounting is described as the accounting constitution. It provides the underlying foundation for the standards. It does not provide the rules, but just what standards do we need to follow in order to account for the transactions that have occurred, how do we measure the transactions, and how to summarize and communicate them in a way that the users can understand them clearly. And the accounting conceptual framework is disseminated through the statements of financial accounting concepts. Here is a picture of the conceptual framework. We've already covered the qualitative characteristics as well as the elements. So today we're going to go through the recognition, measurement, and disclosure concepts. There are four basic assumptions underlying GAAP. The first one is the economic entity assumption. And the economic entity says that we assume the activities by the owners of the business are kept separate from the activities of the business itself. The owners and the business are two separate entities. So when we do accounting for the business, it is separate from the accounting for the owners themselves. The next underlying assumption is the going concern assumption. It's a very powerful assumption in that it assumes the business is going to stay in business forever, or at least for the foreseeable future. It cannot be it cannot be assumed as a given. To illustrate the going concern is the concept of depreciation. When we depreciate an asset over the life of the asset, whether it be 5 years, 7 years, 30 years, in doing so, we are assuming that the business will continue over that period of time. Also, going concern says that the business will survive the owner's life. So if the owner passes away, the business will still survive that. And this is especially true with publicly traded companies. And think back to Apple Computers when Steve Jobs, the founder and CEO of Apple, passed away. Apple still continued as a surviving entity. Continuing on with our assumptions, the periodicity assumption, or it's also sometimes called the periodicity principle, is an important concept because it basically says that the life of the company can be separated into artificial time periods such as monthly, quarterly, or annually. Such as if you're a public company, a publicly traded company, then you have to report your financials on a quarterly basis. And if you're a private company, you have to report your financial statements at the minimum at an annual basis. And the periodicity assumption assumes that that can be done. The last underlying assumption is the monetary unit. And it basically states that you have to use some sort of currency to measure transaction. In the US, it's obviously the US dollar. In Europe, it would be the euro. And also the monetary unit can account for inflation if necessary. And this is really depending on which country you're at. This is more needed in some areas than others. So now, continuing on, we're going to get into the recognition, measurement, and disclosure concepts. First, let's talk about recognition. What is recognition? Recognition tells us when is a transaction recognized into the financial statement. Is it when we make a sale? Is it when we provide services? Is it when we ship our goods, when the goods are delivered? There's a lot of different things that go into that. Measurement discusses is what amount should we record into a financial statement? This would be straightforward. If I sell you a cup of coffee for $1, then I'm going to recognize $1 of income when you pay it to me. However, it gets more complicated. For instance, if you're a manufacturer and you have a sales volume discount and you provide a 2% discount for anyone who buys your inventory at least $100,000 per year. And let's say in the first quarter you sold $70,000 to one of your recurring customers. And typically they buy $100,000 worth of merchandise, but they didn't meet that quota in the first quarter. Well, do you recognize your revenue at 70,000, or do you recognize it at 70,000 less the 2% volume discount? That's what measurement helps us determine. And lastly is disclosure. What information is included in the notes of the financial statements? Giving the reader just a number is usually not enough to help them make any sort of informed decisions about what is going on. Nothing is assured, but assuming that we're not going to go out of business and a business is not experiencing financial difficulties, if we as a business did the work, we expect to be paid. So the revenue recognition principle explains when we should recognize that revenue. We'll go over it very briefly, but there will be a more in-depth chapter on it in the second half of this class. The second part of the year of this class. We talked about revenue recognition. Now let's talk briefly about when do we recognize the expense, when we incur an expense. Well, there's actually going to be 4 approaches to this. And the first one is a cause and effect relationship, which states that expenses are directly related to revenue generation. The expenses that are directly related to revenue generation, such as cost of goods sold. A company does not record the manufacturing costs as expenses until it actually sells that inventory that the cost is related to. Another approach for recognizing expense is by associating expense with the revenue recognized in a specific time. It's expenses like the wages, utilities, and rent that support operations within a time frame are recorded within that period. Another way, the third way, is the systemic and rational allocation, which are expenses like depreciation and amortization are spread over several years using a structured method. So we all know that depreciation and amortization based on the asset that we're depreciating is depreciated over a certain amount of periods. And then the last one is we recognize the expense in the period that it's incurred, such as advertising, and those are recorded immediately because their future benefit is uncertain. Okay, let's go further, and now we're going to talk about measurement and how much do we recognize when we account for a transaction. And there's really 5 different ways, models of measurement that we're going to go through in the next few slides. The first one is the historical cost. We can measure a transaction based on the historical cost, which just says that the original cost paid for an asset adjusted for depreciation. So for an asset, it's whatever we paid in exchange for that asset is what we record as their cost, and liabilities is whatever cash we've given in exchange for assuming a liability. Whatever cash we've received in exchange for assuming a liability, that's historical cost. Another method of measuring the amount to include in the financial statements is using the net realizable value method. And this just tells us to include the expected amount that expected amount of cash and asset will be converted into, less any reasonable cost and other items that we might know of that may lower the amount that we actually would recover in the ordinary course of business. A good example of this is inventory, which is reported at replacement cost as part of the lower of cost or market principle, which means that instead of keeping inventory at the historical cost, it's going to be adjusted to reflect the net realizable value. So if we were to lose that inventory, how much would it cost us to replace it? Another method is called current cost, which is similar to net realizable value, but current cost is the expense required to purchase or reproduce an asset. This method is particularly relevant during inflationary periods. If, let's just say, the price of a piece of machinery significantly increases over time due to inflation, keeping it on the books at its original cost would be misleading to the financial statement user, and so including it at the current cost is more useful information. Present value represents the current valuation of an asset or liability based on its future discounted cash flow. And this incorporates the time value of money and interest rates and bonds, asset retirements, and other obligations for specifically for financial instruments. Use present value calculation when they decide what to record. There's going to be an entire chapter on how to calculate the present and future value, and then an entire chapter devoted to how to account for bonds, which use the present value method. The last method of measurement that we're going to cover today is fair value. And fair value is the estimated market price of an asset if it was bought or sold by independent parties in an orderly transaction. So it reflects the actual market value rather than the historical cost or its projected worth or future worth. Some assets, like publicly traded stocks, have easily determined fair values because they're easily traded on the stock market. So that's called a market approach. There's also others that are not as easily, their valuation is not as easily available. And so we might use the income approach in that instance. And those are estimates of future amounts that we think it will be worth, and then we convert it to present value, which we just covered in the previous slide. Or lastly, we can also use the cost approach, which estimates how much would it cost to buy something of similar value or similar quality and condition. There is what's called a fair value hierarchy that is used in accounting, and it is disclosed in the notes to the financial statements whenever we have an asset or liability that is recorded using fair value. The first, and it's just a 1, 2, 3 level, levels 1, 2, and 3. And the first one is the most desirable because it means that there's a market price readily available for an identical asset or liability. So again, the easiest example of that would be the stock market. The next level is level 2, and this is when the fair value is determined by looking at it's called an observable price for the asset or liability, which means that you can find an asset or liability that are very similar to what you have, and you know the cost or the value of that asset and liability, and use it to determine the value of your own asset or liability. The third and the least desirable, but sometimes it's our only option to determine the fair value, is when you have to make estimates or assumptions in what the value is. So, and those are clearly reflected in the notes to the financials. They'll say this asset we used level 2, and asset number 3 we used level 3. We'll get into that probably in the second half of the year. So we've gone over recognition and measurement. Now the last part of the conceptual framework talks about disclosure. And the full disclosure principle says that the financial reports should include any information that could affect a user, affect the decisions the users make. And there are a variety of ways of how information is disclosed on the financial statements. First, they could be parenthetical comments, which is just placed on the face of the financial statement. So that would be on the balance sheet, on the income statement, stockholders' equity, etc. It would be literally on the face of those financials. Or it could be part of the disclosure notes. So each of these, when a company reports the financials, there's specific notes that need to be included and for every company. And so those are called the disclosure notes. Additionally, there might be supplemental schedules or tables that give more detailed information to those notes, and they might not necessarily be required, but will be useful in helping the user understand what is happening with the financials in the company. The last slide is a summary of the recognition, measurement, and disclosure concepts that we've discussed in this recording, and just so you can get a high-level summary at a glance.